We continue to watch the stock movers. I mentioned Nvidia jumping new all-time highs again, and now this is some good news pertaining to the chips and what they can do for China. Jenny Horne is with us, co-host of Next Gen Investing, to tell us all about it. Good morning, Jenny.
Good morning, Nicole. And yeah, what was seen as a pretty shocking piece of news is the fact that both AMD as well as Nvidia, as you mentioned, are planning to resume sales of some of their AI chips to China after securing now Washington's assurances that such shipments will be getting approved, which is a dramatic reversal from the Trump administration's earlier stance on some of these measured designs to limit their AI ambitions. So the U.S. government officials told Nvidia they would be greenlighting export licenses for those famed H20 AI accelerators, which the company did announce in a blog post earlier on Monday, a move that may add billions to their revenue, as we are expecting them to restore their ability to fulfill these orders that they had written off due to the lost government restrictions. So Nvidia designed the less advanced H20 chips to comply with earlier China trade curbs from Washington, which Trump's team did tighten in April to block then the sale of the H20, as well as these various restrictions that were also imposed on a name like AMD. But AMD has received very similar assurances now from the U.S. Commerce Department, also does plan to restart its shipments of its M1308 chips to China once licenses for sale are approved. So what this means is, I think, first of all, that CEO Jensen Huang meeting with President Trump last week and currently in Beijing to attend a government-sponsored conference clearly has been doing something right. He did appear on a Chinese state broadcaster, CCTV, shortly after Nvidia did announce this decision, saying the company had secured approval to begin shipping. The U.S., though, move comes after weeks of thawing relations between Washington as well as Beijing, guided by this trade truce that's designed to help both sides, at least as far as approve these exports of crucial technologies. But I think that what is so significant about these H20 shipments resuming is not only could it be a boom to names like DeepSeek and Alibaba, which is, I know, been somewhat controversial in the AI arms race, but also it does help Nvidia continue to seek this hardware to train and expand and operate their AI services and compete with the likes of that of like OpenAI still within that region. So this is nothing but, I think, unrealized huge gains for Nvidia that I think that we had priced in, perhaps this not really ever playing out. We had basically written off the H20 chip. So shocking news, but definitely further upside for an unstoppable, momentous run for Nvidia.
Yeah, I mean, it really is incredible. This stock was a $10 stock in the last 3 years, and today, and of course, we also had stock split, but $10 stock, and now, we're looking at over $170 this morning. What an incredible run. And we've had so many guests on who still thought there was room to run, and they're seeing it right now. How about the big bank earnings? I was saying that many of these names are already beating. You're starting with JPMorgan. Tell us a little bit about the numbers, the takeaways.
Well, so I was a bit concerned, I will say, because we went into last quarter with pretty low expectations, and there was for that reason, I'd say the bar was set a lot higher this quarter. We had seen, already like pretty phenomenal results from so many of these major big banks, but JPMorgan earnings show that the economy is still chugging along. So this is, I think, hugely encouraging as well, reporting a better than expected profit for their second quarter, benefiting from some of the market's volatility as well as a steady U.S. economy despite threats of a global trade war. So the total results were skewed by a large one-time gain from a year ago, but the bank's underlying businesses all still increased as far as revenue and profitability are concerned and showed very little signs of slowing down. Total revenue, as was expected, contracted about 11% year over year, but that still actually beat analyst expectations. On profit, that also fell about 17%, which also did come in better than feared. Last year, though, the bank's second quarter were lifted by that $7.8 billion gain related to shares that the bank were holding in Visa. So excluding that Visa windfall, the bank's current results actually would have risen from a year ago, which I think is very critical to note. Also, we've seen, similarly, other major banks do well. I know we'll get more into some of the other results, but I think that we've seen trading desks rake in pretty significant profits this year as investors have scrambled to position themselves well, or at least maybe ahead of some of the uncertainty regarding tariffs and of course, the new president taking over as President Trump has been seen as one that can oftentimes cause some of the dramatic swings in the market. So that actually all boded well for the interest income, representing the profits on lending. For JPMorgan, they were up 2%, which did slightly miss the mark. But on the other side of things, investment banking fees still rose about 7%. So that actually was better than had been feared. So there's definitely still a lot to like as far as the nation's biggest banks still.
Yeah, look, it's pretty much a good report. And you did have Jamie Dimon talking about the current quarter and saying it was a good quarter. And that's good news, but that the risks still persist. He always has to put that cautionary tone out. What about Wells Fargo, which also reported? I see it down in the early morning, but it did have a revenue beat. It did have some beats.
It did, and I think that it's important to differentiate the major banks. I was somewhat saying this yesterday, is like, don't necessarily trade them like the rising tide that lifts all boats, because they're not. We just haven't seen that play out recently, historically speaking. But Wells Fargo did beat its second quarter profit estimates earlier today, but cut now its 2025 guidance for net interest income, sending shares in down about 2% before the open today. So the bank does expect its interest income to be roughly in line with 2024 levels of around $47.7 billion. In April, it did say that net interest income growth would be at the low end of the 1% to 3% range. Wells Fargo also did say that lower interest income in the markets business led to their net interest income forecast, as well as analysts and investors that were skeptical about its ability to meet those targets after a slow start to 2025. So this, I guess, wasn't entirely shocking, but the bank had been at least expecting a difference of what it earns on loans and pays out in deposits to be on the relatively more stable side now in the first half of 2025. They do now still see more modest growth in the second half of this year. We did also see provisions for credit losses fell to around $1.01 billion in the quarter. That was down from around $1.24 billion a year ago, which does help its profit growth now in the second quarter. So this is at the fourth largest U.S. lenders as far as like the way it stacks up against the other major banks. We did also see that the lender did earn $1.54 a share. That was on an adjusted basis. That was well ahead of expectations on revenue. That also was a bit murky, but still, did signal better than expected versus like consensus. So there's a lot to like here, but more so, this is more of a name that's seen as now having to prove itself in the back half of this year, where they did see that slow start to 25, which then does put them somewhat on a league of their own when you compare it to like the stellar growth we're seeing in JPMorgan. Obviously different business models, but I do agree. I always think it's so interesting when we have to see these major leaders of big banks have to add like asterisks to some of their optimism. It's like, well, the results have been pretty strong, so I don't know why we can't just go with that.
Yeah, and look, Citigroup bucked the trend, beat on net interest income expectations. JPMorgan, as you noted, it missed the expectations, but did clock a win. What we really saw was shrinking of net interest income in Wells Fargo. And as you noted, we're seeing a drop in the pre-market. They've cut the outlook a bit. So this one under a little bit of pressure, and you're seeing some of the others as well. So the banks are going to be somewhat mixed today, folks. Jenny, any final quick thought?
I know that I feel like the banks are mixed alongside the market being relatively mixed, but these names don't typically see that volatility or that huge degree of like frothiness that, say, the tech trade does. So I wouldn't say that. Don't let the negative move to the downside we're seeing in banks right now pretty collectively, other than like Citi, for example. Don't let this signal that these results were bad, because if anything, I think these were still better than feared results, at least from the several banks that I've seen report so far.
Yeah, good to see you. Jenny Horne, thank you so much. We'll continue to follow all the earnings news for you folks here on Schwab Network. Jenny doing a great job really covering some of the details of some of those banks this morning, but a busy week as we kick off earnings season.